Diversification is something that folks have been proclaiming for years now. But if you've not been diversified and only been in certain parts of the market, you've done really well this year. Why does that narrative change in 2021?
Well, we think we've got a fundamental change in the market structure now with the efficacy data on the vaccines, the rollout of those vaccines coming through. It means that this shift we're going to get away from some of these stay-at-home beneficiaries, the tech names, the US market, which has been the big story of 2020, is going to shift towards 2021 story, which is going to be more about markets outside of the US, some of the more cyclical sectors, some of the value sectors, which have really been hit hard by the pandemic, we think are going to be recovering in 2021. And really that underpins our positive outlook on stocks. It's not so much about the tech names in the US driving the rally further. It's going to be about that catch-up trade from markets outside and stocks that have been underperforming in 2020.
There's been a growing narrative in the last few weeks and maybe the last couple of months now at this stage, Kieran, where people are saying that next year may be about the return of cyclical, economically sensitive type stocks and sectors that are non-tech. What is the outlook there? Is it going to be industrials and energy and materials, those value type sectors that really lead the way higher in 2021?
Yeah, precisely. So it's going to be in those sectors, it's going to be in the small and mid caps, and it's going to be in those regions which have underperformed in 2021. I mean, I think if we look regionally, markets like the UK, we can see is down 17% this year. That's in contrast to places like the US up by more than 10%. So we've got this big divergence. There's plenty of scope for that to close in 2021 as we get back to some of the pre-pandemic norms, hopefully facilitated by the vaccine.
Now, the reason why I think the market may be pushing back just slightly on that kind of a thesis, because I'm looking at the NASDAQ 100 ETF, the QQQ. It's on an 11-day winning streak. It has now reasserted itself, large cap and mega cap technology, as the leadership in this market. So what's to say that investors don't just fall back to what's been working all year long, and that's that mega cap tech trade?
Yeah, well, I mean, there's certainly, I guess, fundamental appeals to the technology trade. The fact that interest rates are so low means that people are willing to pay up for growth, and we're still getting very good results from these companies in double-digit revenue growth from some of the large cap tech names through this year. So there's plenty of support for those areas. We just think that the valuation gap now between growth and value is sufficiently large that if we can get a catalyst such as more clarity on reopenings, vaccinations, fiscal stimulus coming through in the US, potentially even rising yields, that's the kind of thing that we think is going to drive people away from technology and the US and towards some of these other markets. And to be sure, it's not to say that people shouldn't hold any of this in their portfolio. We just think that if they've made significant gains in these areas through the course of 2020, this is the time to be diversifying away from those into some of the sectors that have got more scope for catch-up.
All right.
Shepard Smith here. Thanks for watching CNBC on YouTube.